Atul Mehra is with us, fund manager, Motilal Oswal Asset Management. Atul, good to have you with us here. Thanks for joining in. You know, in the large cap fund, Atul, it's all, some 20-25% weight in financials, right? So that's the one space, clear way that you're very overweight. We were having this conversation with somebody earlier in the morning as well. Not sort of a huge underperformer or neglected space in that sense, but yeah, relatively, it is an underperformer. What's your sense, Atul? Is it a economy-wide? These are economy-facing large sectors. If the economy's got to turn, instead of picking this or that sector, it should show up in these in financials in a significant way. But having an exposure to your HDFCs and ICICIs, you think that's the right way, or maybe more focused, like a housing finance or specific areas where you think there's perhaps more delta?
Yeah, Prashant. So in terms of financials, I would say that if you look at it from the perspective of last 12 to 18 months time, the larger cap financials have actually outperformed. Like many of the HDFCs, ICICIs, like they've had a 15-20% outperformance over the benchmarks. So what we are seeing within financials as of now is what the larger banks and so on, they are kind of insulated from the current in terms of asset quality issues that you're seeing, which are more pertinent to the smaller names within the financial services space. So that is something that is very peculiar at this point in time. So hence we believe that even at the current in terms of valuations, in terms of a lot of these names are very reasonably priced. And I think, like we've discussed in the past, a lot of financial names are highly correlated to foreign flows. So like we've seen in the last few months, FIIs have again turned kind of net sellers. And a lot of that brunt is felt on the financial names. So I think once things kind of stabilize, you'll start to see them kind of in terms of improve further in terms of returns and so on and so forth.
Atul, hi, afternoon. Was just looking at the key holdings of your large cap fund, and we should just get that up. HDFC Bank, ICICI Bank, Reliance, Bharti, Infosys, L&T, SBI, ITC, TCS, M&M, Kotak Mahindra Bank, and Maruti. That's a quick run through. But some of these, pure consumption names like Eternal, it's a part of your large and mid cap fund, but it's missing in the pure large cap fund, or a Trend, or a Titan. These are absent as a part of the top holdings. Can you explain that?
Sure. So although we own some of these names as well in the portfolio, even in the large cap fund, what you see is the weights in the fund for some of these stocks are on the lower side as compared to the larger holdings like you spoke about. So many of these names, we own it in the portfolio, but they are not as large weights because the thought process is that basically you need to assign in terms of active weights to names where you see a significant kind of outperformance potential. Hence, the better way to look at it would be more from the perspective of active weights rather than in terms of absolute weights, because some of the larger names like HDFC and so on, like they're also pretty large in the benchmark itself. So that is the kind of thought process. Like, so look at it from the perspective of active weights rather than absolute weights, because they are a large part of the index itself.
Atul, hi, good to have you on the show this afternoon. So I was looking at your large and mid-cap fund, where if you look at some of the top holdings, top 5-6 holdings, you have a fair play, on the consumption side, through something like an Eternal, the new age, platform companies. You also have, of course, industrials. I think there's CG Power, there's also Siemens, which is on your list. I think there's also Amber. So, a lot of plays on the manufacturing and the industrial side as well. Now, with these GST cuts happening, are you making any overall pivots in the portfolio, say more in favor of consumption, taking some money off the industrial side, or not? Basically, how are you balancing the two sides of it?
Sure. So in terms of sector-wise, if you look at it, consumer is an overweight, telecom is an overweight, industrials at the margin, I would say, is slightly tilting towards underweight. So that is the current positioning. And what we've seen even from the top-down perspective is in a lot of the government actions we've seen in the last 12 months, the bias is towards reviving consumption, either in the form of income tax cuts that we saw about a few months back, and now with the GST rate cuts and so on. So the government bias, top-down bias, is also tilting now towards consumption, and they want the results more in the near term. If you look at it from the perspective of capex, then capex tends to play out more in the medium to long term. So the top-down tilt, even from the government perspective, is tilting towards consumption, and our portfolios are also aligning towards that theme.
Okay. Got that sense. Within consumption, since you said that that's an overweight for you, and that's a very large basket. So can you drill it down a little further? I mean, and these are not trading calls we're talking about. Someone who's getting into the fund is, you're obviously looking at it from a medium-term perspective. So what's going to be your order of preference? Auto, FMCG, consumer durables, hotels, footwear, value retailing. It's a very large universe. Absolutely. So just give us your order.
So the order is more at the top-down level in favor of discretionary over staples, because see, a lot of, in terms of rate cuts, etc., like we've seen on the taxation side, we believe that they will tend to benefit the discretionary aspect of consumption more than the staples, because staples, by and large, I don't think there is going to be any major elasticity of demand at a 5% lower price point. So the overall tilt is towards discretionary than staples. And within that, obviously, the biggest beneficiary so far, like we've seen even in the stock prices, is on the auto side. But even consumer durables would be a space which would start to revive, I would say, in the next few weeks as the festive period starts to come about. So autos and consumer discretionary in the form of durables, those remain the key, I would say, beneficiaries. Staples would, I would see, like limited elasticity of demand happening over there.
Thank you, Atul, for joining in. Great conversation as always. For the market, still up nearly about